Hello, everyone, and thank you to today's presentation of a nonprofit's alternative to unemployment taxes. We have a great turnout today. I hope you were all able to use your Uber Eats certificates and find something yummy. I know our office actually today got Five Guys for everyone, so I know what I'm having after this presentation. Just a couple housekeeping things before I start the presentation. First of all, for those of you that are here for the SHRM credits, we do get 1 credit for attending this presentation, and we will be sending that shortly after the conclusion of this presentation. We will also be sending a copy of the presentation. So, of course, if you want to take notes, you can, but you will get a copy of this presentation. Also, there is a questions box. I'm sure most of you are familiar with that. There's a questions box available to you. I'm a solo show today, so I might not notice the questions as they pop up, and I do apologize for that. But I will be able to respond to any questions at the conclusion, and I will try to see it. Check those questions out, but I many times miss them, so I apologize for that in advance. But your questions will be answered at the conclusion. And I think that is all for me. You'll get the credits, and this presentation will probably take about 45 minutes, and then we'll see if there's any. Then I can check the question box after that. So. With no further ado, I'm going to go ahead and get started with our presentation. First, I'd like to introduce myself. My name is Heidi Posada, and I am the member recruitment manager here at 501c Services. I started my professional career at the YMCA. My last job there was as an associate executive director, and then I went from there to the American Cancer Society for about 5 years, where I was raising money, and I always like to say I went from raising money to saving money. So I've been here for 14 years working with nonprofits nationwide and helping them evaluate more cost-effective methods for managing their unemployment and also time-saving opportunities. With that said, I do live here in San Jose, California, so it is wonderful to be doing a presentation to all of California, and hopefully down the road, our paths will cross at some point. So besides the Uber Eats certificate, I hope you're all here to learn a little bit about unemployment. I do want to review our agenda briefly. And while I'm doing that, if you want to just write in the chat box, if you were able to order your food, what you ordered. I'd love to see some of the fun things people are getting out there. And enjoying the Uber Eats that you got. Like I said, we're getting Five Guys, so at the conclusion of this, probably before I send out the presentation, I'll be getting my burger and fries. But I chose not to do that while I'm presenting. But the agenda for today is, oh, it looks like we've got a poke bowl. That sounds yummy. Little bit of soup. That sounds like a good idea. Oh, and a sandwich, a ham and cheese sandwich. That sounds very good. Now I'm really getting hungry and want that burger. Anyway, the agenda for today is first to talk about how unemployment insurance works. And then I'm going to talk about the alternatives for nonprofits, specifically 501c3 organizations. And I'll talk about the option of reimbursing and how that works. Show you some real life examples that we have experienced for saving opportunities. And then I'm going to talk a little bit about the company that I work for, 501c Services. So first, I'll talk about unemployment insurance. And I always like to start with a little bit of history about unemployment insurance. Prior to the 1930s, unemployment insurance didn't exist. It did start in the United States in the 1930s as part of the New Deal. From the 1930s until 1972, 501c3 organizations were exempt from providing unemployment benefits. So what that meant is they didn't pay that tax, which can many times be a pretty heavy expense. So that was great news for the 501c3s. All that money was getting to stay with the mission, the great work they were doing. It also meant that if one of their employees was laid off, they didn't have the safety net that others did benefit from. So in 1972, as part of the Social Security Act of 1972, Congress, the US Congress, changed the law. And so now nonprofits were required to participate with the unemployment program. But this was a little bit different because they were given an option. They were given options. It wasn't just strictly you're paying taxes. So we're going to talk about those options. But first, a little bit about state unemployment. And the good news is we're all here from California, so I can use some real numbers. But just the big picture, unemployment is managed big picture at the federal level, but every state manages it themselves. So the big picture federal level, that's where Congress says all nonprofits have options for how they manage their unemployment. On the flip side, every state gets to manage their unemployment program. So you see various taxable wages, you see various tax rates, a lot of different ways they've chosen to manage their unemployment at each state. Weekly benefit amounts vary tremendously from state to state. But like I said, since we're all California here, I can focus on California. One thing here in California, the rates can be adjusted annually. So what you all might notice is if you have a year or two of bad claims, that's obviously going to increase your tax rate. The program is run as a state pool. So there are, even if you don't have many claims, the state many times will apply claims to your experience, which is going to increase your rate, even though you've maybe had no claims. So at the end of the day, the state will take we'll calculate the tax liability by taking our taxable wage base, which is $7,000, and multiplying that by your employer tax rate, which can be as high as 6.2%. So real quick, I like to think about the cost of unemployment. And California's, for the cost of living here in California compared to other places in the country, our weekly benefit amount is actually fairly low. But I'll give you a second to try and think about what do you think the cost of unemployment is. And this is if someone had the maximum weekly benefit amount for 26 weeks. What could that possibly cost? And it's as much as $11,700. So if you are paying in the state tax and someone files for unemployment, you could have as much as $11,700 going towards the calculation used for your tax rate. So specifically, California, the maximum weekly benefit is $450, and you multiply that by 26 weeks, and that's where we get the upwards of over $11,000 for the maximum. Our wage base here is the least amount. It's one of the federal government rules is the wage base has to be at least $7,000. So we are at the minimum there. But what happens though is our tax rates are a little bit higher than some states. States like Washington that has a really, really high wage base, their tax rates are usually, when I do proposals for them, many times below 1%. So the state gets us here, they might have a lower wage base, but they sometimes get you by giving you a higher tax rate. Now, one interesting thing is the improper payment rate, which is 20% here in California. That's very high. What that translates to is almost $2 billion in overpayments just in California. So you can do everything and on an administrative side, manage your claims, manage your, protest claims. And then here, as a tax-paying organization, you can be hit by errors made from the state. This information is taken directly from the Department of Labor, and you can see California greater than 13% is the highest we go on this chart, and California is nearly 20%. So a pretty high error rate, which can be frustrating when you're managing an unemployment program on your own, because it might be hard to catch those errors if you're managing this without any support. And I know we were just talking in the office, it was about 4 years ago today, they started closing offices here in California. Some people say it seems like a lot longer ago. Some say it seems like yesterday. So, but 4 years ago is when COVID happened. And of course that impacted unemployment tremendously. It was something that was, I've been here for 14 years. It was weird to see my industry headline news for a while. So we're still looking to see what happens in California from if there is any changes in our taxable wages or maximum tax rates here in California. We do have a pretty significant debt to the federal government. But normally, even without COVID, I'll tell you, on average, even if we're just in an average year, most organizations pay $1.28 into the state pool for every dollar they take out. So if you think about that, if you think about, multiplying that out, that can be a pretty substantial overpayment if you're paying $1.28 and only getting $1 back. It's possible if California makes some adjustments, which are always talked about, that it could go as high, the average during the recession of 2008, 2009, that replacement went up to $2.04. So for every $2.04 an organization was putting into the pool, they were only getting a dollar back. And that's because they need to have money in their pool, and they need to have excess money. They can't just be flat pool. They need a mountain of money so that they can have funds for future recessions. So right now, though, we can say we're lucky as far as California. A lot of states have made some significant adjustments to their unemployment rates as well as their taxable wages. But here in California, at least up until now, we have maintained the same taxable wages and rates from pre-COVID. So looking at some alternatives, if a lot of you, and I looked at the registration, quite a few of you indicated that you do pay state unemployment taxes. And I'm here to talk about an alternative if you don't want to pay that $1.28 for every dollar you get back. That's really what we're here to explain why this is a benefit for a lot of nonprofits. So the options you have right now are you can pay the state unemployment tax, or you can self-insure and reimburse, which means you're paying dollar for dollar instead of the tax rate. I'll go much deeper into detail for that. Or you can even buy insurance. There's opportunity to buy insurance that's similar to the state tax, but going through a private company like 501. So how reimbursing works? First of all, I like to reimbursing. Not everyone qualifies. We're hoping that everyone here is an employee at a 501c3 nonprofit. There are other kinds of like 501c6s and other kinds of nonprofits that do not qualify for reimbursing. We also recommend that an organization have a payroll of $1 million or higher. And that's really because if your payroll is less than $1 million, your tax is probably pretty low. So even one claim a year could be more costly to your organization than paying the taxes. We also hope that you have a positive audit over the last 3 years. So what that means is that over the last 3 years, we hope, and we like to look at these numbers and help you evaluate this. We hope that that in order for reimbursing to be good for you, that your tax, what you've paid each year in taxes, exceeds what you actually paid in unemployment claims. And also, if we want to make sure that you don't have any major disruption in funding expected in the next 24 months. The reason for that is if you know that you have a layoff coming, or you're pretty sure you're going to lose a grant and close down a program, you're probably best off paying in the state unemployment tax system until that's over. And we're kind of looking at like buy low, sell high type of experience. But instead, wait until you get those claims filed against you, your tax rate goes up, the claims go away, and your tax, so go out when your tax rate goes up and your claims go decrease. So what it means to reimburse. So hopefully you qualify for all those bullet points, and you can look and think about reimbursing. And if you are a reimbursing organization, you can consider, is this the best option for your organization? What it means to reimburse is basically your tax rate turns to 0%, and the state, instead of charging you for a tax, they charge you dollar for dollar for what your unemployment claim is. So it's for a lot of organizations, it's a great way to save money and be a better steward of donor dollars. The process, excuse me, the process is very seamless for separated employees. What I mean by that is, if no matter how you let an employee go, they leave on their own, they're laid off, whatever the circumstances, if they file for unemployment, they're still going to file with EDD. They're still going to do the exact same process. They have probably, unless they're in the administrative office, probably have no idea how you're funding that claim. The state will determine their weekly benefit amount based on their base period pay, and they will send them through California. I think you get a credit on a debit card. So they'll apply the money on their debit card, and the employee doesn't know that you've changed how you manage unemployment. For you, the only thing that really changes once you submit the paperwork to the state is your billed. And so in most cases, instead of paying a higher state tax, you save your organization money. So again, on average, we do quite a few cost analyses each year. We collect the information that I just talked about, the claims history and what people are paying in taxes. And just through our own experience, our average savings that we look at for an organization can be anywhere between 20 and 40%. How that translates that totally depends on what you're paying in taxes. I'm going to show you some examples of real assessments we've done. But the savings is really the driver for most organizations to switch to reimbursing. It also, you eliminate any concern that the state might increase the taxes down the road. You eliminate that concern. And like I said earlier, it's really just a better use of donor dollars. So if you're, regardless of how you're funded, I think it's good that you're paying just for your actual claims and not overpaying into the state pool. And how reimbursing works, the great thing is, like I said at the beginning, big picture unemployment is managed by the federal government. And so because of that, reimbursing is allowed in all 50 states. And like I said earlier, best for employees with $1 million in payroll or over. If you are on the borderline, we'll certainly talk. Sometimes there's a circumstance that we can say, let's go ahead and look at reimbursing. And if you're already reimbursing in smaller, we can definitely look at providing our services to help reduce your risk with reimbursing. So there's different ways, different opportunities when it comes to reimbursing. So the first one is, you can say, hey, yeah, we're saving money, and let's manage this on our own. We've been managing through the state. Okay, let's manage this on our own. That can be risky. It can be risky because there's highs and lows of unemployment. If you have 1 or 2 full-time staff leave, it could increase your monthly payments $15,000, $20,000, even $30,000 if you have a few other people leave. So you just want to make sure if you are managing it on your own that you're aware of the potential highs and lows that that can come from managing your own program. And you also want to make sure that you're really diligent with managing your unemployment claims. You probably want to, if you can, you want to audit your claims, make sure that you're not experiencing those overpayments that California has. And you also want to make sure that you're protesting every claim that is not viable. So I know a lot of us in the nonprofit world say, you know, we really, Johnny didn't work out, but we really like him. We want him to have the safety net, and so you don't protest those. And that's completely up to you. But it is a cost to your organization when you choose not to protest claims. Another option for reimbursing is to outsource. And you can use a company like 501c Agencies Trust, and they will help you with some of the challenges that come when managing on your own. So helping you put money aside for a rainy day, that's the trust part of our organization. It's a fund that's owned by our organizations to save for higher than expected claims. And the third option is to purchase insurance. We do, and here at 501, we do offer insurance options that can, you know, they're usually a little bit more expensive than being part of the trust, but you can have different kinds of levels of protection with that insurance. So like I mentioned, we do have some examples of the savings that some of our nonprofits, these are real cost assessments, but first I'm going to go back and review the taxable wages and the tax rate. So again, this is customized by each state. The taxable wage base is $7,000 here in California. And if some of you, and I know this is getting to be more and more common, that you have employees in multiple states, and I do want to say this, everybody here is from California, but we do work with all 50 states. We have a lot of a lot of organizations that have staff in multiple states. So if after this, if you want to follow up and do a call with me and talk about some of if you have employees in other states, we can certainly talk about that and talk about managing your unemployment at for as many states as you're in. But for today's purposes, we're focusing on California. So I'm sure most of you understand what the taxable wage base is, but that is the first $7,000 of an employee's earnings. So here in California, because of that, if you have all full-time staff and you're not hiring any new staff, it's almost guaranteed that you're paying all of your taxes in Q1, because once each of your employees hits that $7,000 threshold, you're not paying any more taxes. If you're an organization, we work with a lot of YMCAs. So if you're like a YMCA that has a lot of seasonal staff, a lot of part-time staff, you're going to be paying still the major chunk of your unemployment in the first quarter, but throughout the year, you'll continue to pay, especially in the summer for a YMCA type program that has a lot of seasonal and summer employees. So that's something to keep in mind if you are paying taxes and you're looking at opting out of the state unemployment insurance. When's the best time to do it for your organization for the maximum savings? And just know that the tax rate here, it really can increase or decrease, and you get that notice in December. And at that point, you can kind of budget for what you'll be paying in taxes in the upcoming year if you're currently paying SUI. Contribution amount per employee based on the $7,000 times the 1.6 up to 6.2%. So per employee, you're looking at paying anywhere between $112 to $434, assuming they make the $7,000 per year. Of course, for a part-time employee that makes less than that, it'll be slightly less than the 112. But just the 112 to 434 is per employee making $7,000. So these are, we've put together some examples of some real nonprofits that we've worked with, that we've done a cost assessment for. If you are currently paying taxes, we'd be more than happy to look at your numbers too and see if you have an experience like some of these do. For this first one, this was a human services nonprofit that we worked with last year, and their taxable payroll came in at just shy of $1 million. Their tax rate was 4.7%. Their estimate, so we take a 3-year average of claims. This one's claims over the last 3 years were only averaging $200 a year. My best guess is they had 1 year of 600 and 2 years of 0. But anyway, they had average claims of $200, and so we were looking at their estimated unemployment taxes being just over $45,000. That's what they're paying every year. And so what we look at is the estimated overpayment of $45,148 for this organization. So this is really a perfect example of what we look at for being a better steward of donor dollars. Wouldn't you rather take $200 of donor dollars rather than $45,000 to pay for that tax? And we also did an evaluation for an SPCA. And for that one, the taxable payroll was $707,000 and the tax rate was just under 4%. And their estimated claims a bit higher than the last one. Sorry, we have the claims and unemployment tax mixed up. But so their estimated taxes were 23,000, so almost 24,000, and their estimated claims was 6,000. So their estimated overpayment here was $18,000. So again, you probably saw my picture of my dog at the beginning of this. I love my rescues. I don't want to see the SPCA paying extra if they don't have to. So if possible, and if we'd love to see the savings of almost $20,000 per year. So this is how SUI is calculated. Is a lot of people, I think, get this form. First of all, a lot of payroll companies get this form and staff don't even look at it. If you do receive this form, a lot of people don't understand what all of the numbers represent. So I just want to take a minute, and if you are able to dig out your EDD form after this, you can certainly look at it and kind of get your own look at if you're overpaying. So first of all, California has a 0.1% training tax. So they first give you your tax rate, which here was 1.7%, and then that training tax is an added 0.1%. So that's 1.8%. In the middle of that tax rate is something I always find interesting, and that is the UI rate schedule. In addition to changing tax rates and taxable wages, a state, and this is just based on calculations, a state can change the UI rate schedule. So a lot of people I talk to are like, oh my gosh, I'm an F. Well, that's actually the whole state of California is an F, which means we're at the highest tax table possible. And that's because California is in debt in their unemployment pool. Their unemployment pool is negative. So because of that, we're an F+ rating, which means your tax rate is higher to help fill in that pool. So this organization was actually quite healthy. They had a reserve balance of almost $200,000, which is why that tax rate is pretty low for them, that 1.8%. That's line item number 1 on the screen. Line item 2 shows the contributions they paid. That's another one I like to highlight is so this one, and this is exactly where we get those samples from. This one paid about $23,000 in taxes the previous year. And then if you look at line item number 9, how does that compare? Well, that year they paid only just shy of $1,300 in unemployment claims. So, you know, a real life example, you saw the assessment summaries that I had, but a real life example of, you know, just looking at your tax rate notice and seeing, oh, 22,000 versus 1,200. So that's something you can do on your own, and we'll also certainly help you collect more, tell you the additional data that's helpful to do a cost assessment to make sure that it's a good, not just a one bullet point, but help you find additional bullet points to make sure it's a long-term savings. One other thing I want to point out here, and that is line item number 10, which is increase in total of all negative reserve account balances. For this organization, they got $6,500. And what that means is the state, this organization only had $1,200, but they applied another $6,500 in claims. So that's kind of like if you're driving your car and you have no accident, but your car insurance dings you because everybody else got in a car accident. That's what that one is. So that's another place that, you know, this organization's doing great managing their unemployment, but then the state came in and just increase, you know, is trying to increase their rate by throwing in those extra charges. So now I want to talk a little bit about 501c services, the company I work for, and the host of this webinar. We were founded in 1982 here in San Jose, California by a retired UCP executive. His name's John Huckstead, and he was looking at ways of saving money for his organization and came up with the idea of starting a trust. We started with about 25 members here in San Jose, and we've grown. We're now helping over 3,000 nonprofits in various ways. And in 2016, John sold the company back to his employees. So we are now 100% employee owned, which the only reason I bring that up is because honestly, from the receptionist, which we actually have a receptionist, so if you call us, you get to talk to a real person. From receptionist to CEO, everybody is very committed to our company and committed to committed to serving our members. And I don't know if I have this in a future slide, but we have about a 98% member retention rate. So the services I'll talk about are valued tremendously by our members. I've included a couple testimonials here. I am sending this, I'm not going to read the testimonials to you, but certainly when you get this packet, you can skim over what some of our local California members have had to say. And I'm gonna see if this works. Oh, look at that. I think it's gonna work.
Our overall experience with 501 has been seamless. Whenever you outsource something that's so critical as a benefit to your employees and an obligation you have, you really want to hand over to someone who's going to treat it as importantly as you do and do it as well as you
do. Oops. So that's just a very quick, short summary of one of our testimonials. But we, like I said, we work with almost 400 nonprofits here in California. Oops. And here's a sample of some of the nonprofits that we currently work with. So you might be familiar with some of them. Who knows? Maybe you've worked at one of these organizations. But this is just a quick snapshot of some of the California nonprofits that currently use us and reimburse for their unemployment with us. So how do we help nonprofits? Well, the first way is through claims management, and our claims management team will help you protest claims. They'll help you, and they will also audit the claims behind the scenes. So you'll have a dedicated claims manager if you become a member of the trust. And another fun thing is all of your claims come in through an online portal. So you get an email notifying you that a claim has been filed, and you can just go onto the portal, respond to the questions. If you happen to take PTO and you forget about delegating your unemployment management side of your job, that's not a problem. You can set it up so whenever you get a claim that's not responded to within a certain number of days, it gets escalated. So those can always be handled. So a big part of the claims management, especially for reimbursing employers, we don't want to see you overpaying. We don't want to see you hit by those California error rate of 20%, so we can audit those charges for you. And we don't want you to pay for a claim when someone was terminated. So we want to make sure that you're managing those claims and have the support to do that. We also have HR services, which is 3 components. It includes unlimited access to HR consultation, which we're different than a lot of, I talk to a lot of people that, oh, with my payroll company, I get that. With my X whatever, XYZ company, I get these kind of services. We're a small handful of people that are responding to your calls, any HR related question that you have, FMLA, disciplinary. So if you do have an ongoing issue, you can really develop a rapport and a relationship with the person on the other end of the phone. And so they can support you in managing some of your HR questions. We also, with our HR services, have trainings. So similar to this, they offer a number of trainings throughout the year. Most of them are HRCI and SHRM certified. And there's also an online knowledge library with our HR services. So when we look at reimbursing and you look at paying weekly benefit amounts, $450 maximum weekly benefit here in California, our goal is really to help you keep that cost as low as possible. So the claims management, of course, is one tool we have for that. The reemployment is another tool. We can, if you are laying someone off, or a team, maybe it's a department, you can offer them through us reemployment packages. And these consist of anywhere from online coaching all the way up to personalized one-on-one coaching for interviews, techniques, resume writing, all of that stuff. So for you, as someone who's probably in the room having to let someone go, that's no fun, even if it's someone that you need to let go. But at least you can give them the safety net, so it's a win there for that employee that has this resource if they want to use it. And hopefully if they use it, they find a job even 1 week, 2 weeks faster, you've just saved $900 by using that reemployment package. And then the protection is the insurance part of our program. So most of our members do take what we call stop loss protection, which really helps our members in times of catastrophic claims. We were just talking to one organization last week that's lost a pretty major grant, and so they're going to have a significant layoff. They're not with us right now, but had they been with us, they would have most likely a pretty substantial reserve account to help them. I'm sorry, they would have the stop loss protection to help them with the catastrophic claims that they're going to experience. And on the flip side, for the less catastrophic claims, just for the managing highs and lows of unemployment, we have the trust, the savings account. And this is a reserve account that's owned by your organization. You benefit from the reserve, the investment returns. It's an average of 4%. So I hope I've piqued your interest, and I hope that this is something that you are interested in looking at to see if managing your unemployment through us as a reimbursing employer is a good idea for your organization. All I need from you to do a pretty thorough analysis is a copy of your 941s or estimated payroll from 2022 to 23. And then if you're paying SUI, a copy of your 2023 tax rate notice. And if you've got your 21 and 22, that's super helpful because then we can look at some additional data points for you. For whatever reason, California nonprofits have a really hard time getting some of this information. The 941s is of course easy, but sometimes they have a hard time getting their claims history. And I think EDD might be a little bit harder to call and get the information in some places. We do have a cheat sheet for you. So if this is something you want to look at and you can't find your tax rate notices and you're banging your head against the wall, don't struggle too long. Let us know, and I'll show you the cheat sheet on how to call EDD and how to contact them. And hopefully that will help you get the data you need so that we can do an analysis for you. So that is all I've got today. I do have a little time for Any questions in case anybody has some? Otherwise, I'm going to sign off and start. Either myself or my colleague Janessa will be reaching out to you to give you the copy of this presentation and the your shroom credits for today. So great. I must have been so thorough. I'm not seeing any questions come up, but if there was any that I missed, like I said, I will make sure to address them either today or tomorrow. And that completes my presentation for the day. Thank you.